Welcome, everyone, to the first quarter 2026 Feldmeyer Forecast. Today, myself and Ben Feldmeyer will be hosting, and we will jump right into what we'll be covering today. So we are going to go over an economic summary of what happened last year in 2025 and how the market reacted. We're going to look at the S&P 500 and what all makes up the S&P. We're going to look at the consumer balance sheets and how they're spending their money. We'll take a look at 2026, looking forward, and any economic stimulus that might come into play for this year. And then we'll also look to see how can we take advantage and invest in 2026. Before we get into that, we want to go ahead and do our fourth quarter headline recap. Since October 1st, there has been a lot of things that have happened. So the U.S. federal government entered a shutdown after federal funding expired at midnight. The MLB World Series, the Los Angeles Dodgers won their second consecutive World Series title. The Federal Reserve met and cut federal funds rate by 25 basis points. That was their third cut of the year, leaving a target range of 3.75 to 4%. On October 19th, there was a jewel heist that occurred at the Louvre Museum in Paris, with thieves stealing over $100 million in valuables. The U.S. military officially launched the Operation Southern Spear, a mission to attack boats in the Caribbean and Eastern Pacific, allegedly involving drug trafficking. The NFL held an international game in Madrid, Spain, a major movement for the league's global expansion. Data indicated that the U.S. labor market continued to slow, with jobs gains becoming increasingly concentrated in the healthcare sector and overall job creation moderating significantly. The Formula One Las Vegas Grand Prix was held on the Las Vegas Street Circuit. A movie blitz hits the big screen with 3 of the top 5 grossing films of the year coming in November: Zootopia 2, Superman, and Wicked for Good. Major storms, including Hurricane Melissa, caused widespread devastation on the Caribbean and Philippines. The U.S. government shutdown ended for 45 days, making it the longest in history. The Trump administration announced a $12 billion of farmer bridge payments for American farmers affected by the new tariff policies. On December 23rd, the initial estimate for the third quarter GDP was released, showing a strong 4.3 annual growth rate, a 2-year high driven by consumer spending and AI investment. The AI investment boom, venture funding in AI-related field surges to $211 billion in 2025, with fourth quarter funding up 13% quarter over quarter, fueling a significant, albeit concentrated, market rally towards the end of the year. And then finally, and unfortunately, we close out December 31st with the Ohio State Buckeyes losing to the Miami Hurricanes, ending their chance at a repeat national championship. So a lot happened over the fourth quarter. And with that, we take a look at where things ended 2025.
One of the things we talked about last quarter was the Magnificent Seven and their performance on things, primarily being driven by their profit growth. So if we look at the top left-hand corner, this is information that we covered last quarter as well, simply showing the S&P 500 rates of return in black. And then in blue, we see this S&P 493, which would be the S&P without the Magnificent Seven. And then in green, we see the Magnificent Seven. And the growth in their profits is what we see there. So if we look in 2023, for example, we see in green the 76% growth on things. That's significant. And if we look at the right below that, what we see is the year over year earnings growth. So in a year like 2023, where the 493 companies in the S&P 500 had negative earnings growth and 7 stocks had 31% earnings growth, it's pretty believable that their stocks would do very, very well. And over on the right-hand side, we see that in green, we see the S&P 500, and then we see these 7 names here of NVIDIA and Meta and Tesla and Amazon. We can see all those. We see this continues again in 2024, but we see one of the companies lagging. And then in 2025, what we see is that only 2 companies outpaced the average of the S&P 500, all added together.
So those two companies would be NVIDIA and Alphabet, or Google.
What we call Google.
Yeah. So Alphabet's the parent company. And we went over this last quarter, but we think it's worth bringing up again. If we expand out to the top 10 companies, the high weighting of these companies in the index. So even if only two of the seven outperform the S&P 500, the size of NVIDIA and Google are able to still push the entire index performance around because they're just such a big component and so concentrated. So the top 10 companies of the S&P 500 by size control almost 40% of the return. If we take a look at the consumer and consumer finances, remember a lot of these earnings are coming from where you and I are spending our money, right? Where are the consumers spending their money and who is profiting from that? What we see on the left side, we won't spend too much time on, but we have a great balance sheet. So consumer net worth has been I would say close to an all-time high, if not an all-time high. But where we really want to concentrate for 2026 looking forward is the right side of the chart, which is household debt service. So if we look at the top right side of the chart, we see that of money coming into the household as a percentage of disposable income, 11.6% of that for all consumers across the US are going out in form of debt payments. Now, while that has risen since the bottom in 2021, where a lot of consumers used their stimulus money from the COVID stimulus to pay down debt, what we see here is we see this is about the same level, if not slightly below, where we were from 2010 to 2020. So for about a decade, we had very reasonable debt to income ratios, and we're right back to where we are. So we do want to keep an eye on that. But if we go down here to the bottom, we do see some of that debt and some of those early delinquencies starting to rise.
And if we look at the decade there of 2010 to 2020, with the household debt service being maintained right about the level we are right now, that was a very prosperous period for the markets. We did very, very well. It's kind of slow and steady wins the race. If we went to where the arrow is pointing here and we expanded 2025 into a much bigger chart, what this chart doesn't show is that things are starting to creep upwards. Delinquencies on credit cards, mortgages, student loans, all these types of things are rising. So that's kind of a forward indicator of the fact that there's a percentage of the population that is overspent and is falling behind on their bills. Excuse me. However, excuse me, as we look at the wealth in the United States, and the wealth that's been created on the left-hand side, what we see is that over the last 5 or 6 years, wealth has grown significantly, primarily driven through investment in the stocks that we just took a look at. The amount of wealth that's been created here is significant, and it's leading to the upper tiers of the population having more money to be able to spend. So at the top right-hand corner, what we see is that in black, we see percentage of the total pre-tax income, and in blue, we see spending. So those who are making half of the income in the United States are doing about 38% of the spending. Now, we are all familiar with the old 80-20 rule, right? 80% of the business comes from 20% of the people you're doing business with. This is kind of falling back into the same type thing. We see a whole lot of money pushing the economy around by those who have created wealth. Free cash flow will come into play later, 26. On the bottom right-hand corner, what we see is income tax returns. And because of the changes in the tax code relative to people over 65 getting an additional standard deduction, no tax on overtime, no tax on tips, which a lot of that stuff was impossible for anybody to put in place as part of their payroll system. There's a lot of folks in the population who are going to be getting some pretty substantial tax returns on things, which, as you can see from the bar chart, going up from a little bit over 3,000 to closer to 4,000. And we know that that money will get spent and it will have an impact on the economy.
So if we take a look at the different investments when we look at a balanced portfolio, there are large companies that we talked about with the Magnificent Seven. There's medium-sized company and small companies. What we want to focus on for this chart is the small cap companies and kind of what sort of return that they are receiving. And if you look at the small companies valuations and earnings, what we see for small cap here, 39% of them are unprofitable when we are looking at publicly traded companies. So large companies continue to make money. Most of those are profitable. Even most of the medium-sized companies are profitable. But a lot of these smaller companies, there's a trend in the industry to take small publicly traded companies, buy them where there's opportunity, and actually bring them private. So if we want to continue to have a balanced asset allocation and invest in small type of companies, we need to look to where the small companies are profitable and how we can invest in those companies. And that is something we can do through private equity.
So what we're seeing is that a lot of the profitable publicly traded small companies are being purchased completely, taken off the market by private equity firms, private companies, and that leaves behind those who are not so profitable. And when we look at these and we see the private equity dot right here, what we see is on the left-hand axis, we see the vertical axis, we see an average rate of return close to 15% over time. And on the horizontal axis, what we see is that this actually carries a lower correlation to a traditional balanced portfolio. So this is a nice thing to add in that says it's historically been making good rate of return and it's not correlated to the existing investments that we have.
And one thing to note, the circles on these, the size of the circles don't really have anything to do with either the performance or the opportunity. It has to do with the yield. So how much dividend reinvestment or how much dividend yield are we getting from these different investments? For private equity, there's really not too much of a dividend because we are more looking for higher rates of return in terms of return of capital.
Yeah, growth.
Where if we wanted dividends and yield, we'd look to more of the private credit, infrastructure, or even transportation or real estate.
Mm-hmm. Which we do.
Which we also do. So taking a look at big picture, right? Because investing is not just here in the United States, but it's overall where we are globally, right? We can invest everywhere and anywhere to make sure that we have a diversified return. And if we take a look at the last 15 years, the annualized average for the United States versus Europe, the US outperformed not quite by double, but pretty darn close, 14.1% versus 7.8%. And even if we look at 2024, the US was still one of the best places to invest, where Europe was underperforming. So there has been a lot of years where Europe and some of these other international companies have been underperforming the US. One thing that we saw in 2025 is Europe really became a lot more attractive, right? Because there was either a different part of the market cycle, there are companies that are discounted, and then the US dollar was also depreciating. So all of these are returns based in US dollars. So if we're investing here in the US and these other companies, where's the opportunity? One thing that really stems from the return from Europe is the actual currency. So you can see the US dollar depreciated last year compared to other currencies in purple. And you can see a large portion of that return was just from the US dollar and the euro changing in values to each other. So we think that will continue to be a trend this year as the dollar continues to depreciate, where that might help for trading. It will be also a tailwind for international investing when we invest here in the United States.
So it makes our goods cheaper for foreign entities to buy them, which is one of the things that the administration is wanting to do. The other thing is that if you make money in a foreign currency, when you go to buy back the dollars, you can buy back a whole lot more dollars.
Right.
Right?
Yep. All right. So as we wrap up here, just want to review some final points here. 2025 was volatile but positive overall. We expect more of the same for 2026. We do see rates trying to be pushed down, which will again encourage spending. We see those tax returns coming in. That should encourage spending. But in the second half of the year, it is a midterm election year, and we do tend to see a lot of volatility. Not to say we won't end the year positive, or not that we can't end the year positive, but we expect more volatility. There will be more to come to that. This fall, we'll do another midterm election presentation. We have a speaker lined up to come in. So again, more details to come on with that as we finalize everything. The S&P 500 is becoming very concentrated, but we also do start to see a broadening out of rates of return. So we got to be very careful about where we're investing.
The biggest thing too is, excuse me, is from a risk discussion and mathematics standpoint is we want to be sure that we've got a benchmark we're comparing to that is truly a diversified mix. So we're looking at including the entire stock market index as opposed to just the S&P 500, because we want to be sure we've got good math on things, that we're setting realistic expectations in terms of our discussions.
Yeah. We are seeing debt balances and delinquencies increase, but it is not yet widespread. It is something we will keep an eye on. The stimulus will certainly help this year in the form of tax refunds and lower interest rates. And then private equity is being added to our alternative sleeve to reduce volatility as we seek those positive returns. International is expected to continue to do well, so we are continuing to increase our exposure there just like we did last year.
So overall, we're expecting a good but relatively bumpy year. Business looks good. Things are favorable toward business growth, right, between policies and fiscal policy on things. So we'll see.
And with that, we appreciate you guys tuning in for the first quarter Feldmeyer Forecast and hope to see you again next quarter.